Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and today is Friday, September 12th. It is currently 1:29 p.m. Pacific time, and I'm here with my good friend, Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies, and we are here to record another installment of Investment Friday, and it's been kind of a crazy week. There's been a lot going on, right, Brad? So what are we going over today? We got a lot of stuff.
It has. Uh, I'm going to talk about the economy, but I do want to address the Charlie Kirk shooting at Utah Valley University. Um, it's a tragic trend in the United States that unfortunately extremists on both sides of the aisle are deciding to take violence into their own hands to work out public or political differences. Just a couple months ago, we had a Democratic state senator and her husband were killed um, by some Republican or some extremist, some far right individual. And then this week we had Charlie Kirk get shot. Fortune, they've captured the the person that they believe who committed the crime. And that's what it is. It's a crime. It's
Mhm.
murder, and we our hearts and our minds go out to his family, his wife, and his two children, and all of his employees and his friends and family that are suffering at this time.
Yeah, it's my deepest, truest stance on this is that there's no space for gun violence, political violence, in what should be a functioning democracy, right? We just can't. And the wave yesterday of violence and shooters at historically black colleges and universities. I think there were three or four
Yep.
different reported active shooters. It's just unconscionable, right? Like it doesn't make sense. And when we have a flashpoint this publicly, I will say, like it was very, very visible. If you want to put it that way, Melissa Hortman and her husband and her dog earlier this year, right? Like this is it, it's not it's not a right or left issue. This is a human issue. Um,
Yeah.
so
I mean, I agree. I think that, people need to be humans about this and understand that at the end of the day, he was a man, he was a family man, he loved his family, he loved the country. He may have disagreed with you on political beliefs or how to run the country or what have you, but the way we usually work through that in this country is supposed to be through debate and dialogue and compromise and learning.
mhm.
And unfortunately, that trend in violence has been ratcheted up. So hopefully, political leaders on both sides of the aisle, which I've seen a concerted effort to kind of dial down the rhetoric in terms of how divisive they are, because there are people out there who are mentally not as stable as you would like, who are taking in those messages and may choose to act upon those messages in a way that the leaders never intended.
Right.
And so that's unfortunately, kind of the world we live in right now. That said, if we want to, I'm going to transition on over to economics and the markets and the normal investment Friday um, schedule. So this week we had a couple really important data points come out. One was the producer price index, which again gives us that intermediary price pressures, in the manufacturing cycle, from raw material to end good, what is kind of the in that supply chain, what is the inflation? And it came out less than expected. In fact, it came out negative. It came out negative 0.01%. Um, I should say that again, negative 0.1%, relative to the expectation of positive 0.3%. So everybody was expecting it to go up just a little bit, but it actually came in negative with actually a revision on the month before down as well. So that is really good. It means it gives the Fed a little more data to go ahead and lower interest rates. That maybe inflation's not nearly as high as we would anticipate, at least coming down the road. We also got consumer price index yesterday on Thursday, and core was 2.8% year over year, and the all-in CPI was up. Hold on, I'm going to get that wrong. I just want to get that data correctly. Um, yeah, CPA came in year over year about 2.9% as well, with core inflation being 3.1% year over year. And what I want to reiterate to everybody listening, those are really, really good inflation numbers. Now, the Fed has an arbitrary target of 2%, which was set in 2011 with negotiation with the other developed markets, the other developed economies, central banks. Um, it's not indicative of the United States' experience since 1929, where inflation's roughly averaged over that long period of time, 3%, give or take a little bit, depending on when you take the snapshot. 3% is a really good inflation rate. It allows corporations to continue to grow their earnings. It doesn't hit households as hard, right?
Hmm.
Particularly compared to 2001, 2002, where we were looking at 10% inflation rates. A 3% inflation rate is a really, really good, tolerable inflation rate. Um, and so that's good. It should give the Fed a little bit of wiggle room to say, okay, if the job market's weakening a little bit, and the inflation rate's still somewhat kind of around the average,
Hmm.
do we have a little bit more wiggle room or bandwidth to lower interest rates? What I want to remind people is this will be the fourth interest rate decrease in this cycle. We
Oh,
lowered
wow.
them three times. We paused for a very, very long time. And so now they're going to lower again. People forget that they've already done a couple of interest rate decreases here in 2020, 2023, 24. Then they paused for a very, very long time. And so now they're just going to resume based on the new data. So that's good. Now, um, one of the things we like to talk to people about if we want to, you know, move on from the calendar, is kind of an educational piece.
Hmm.
Okay. And that is interest rates are going to, next week, we have the Federal Open Market Committee. That's the committee on the Fed that controls interest rates. And they're meeting, and in that meeting, it is widely expected that they will drop interest rates by 0.25%, or in Wall Street vernacular, a quarter point. Okay. So that's widely expected.
Right.
Now, what does that mean to you? What, as the investor, what does that mean to you? How is that going to change things? Well, if you have a savings account, or if you have a money market fund, or you have some very short-term safe asset that you are placing cash in that is earning an interest rate, more likely than not, those will adjust lower in returns
Hmm.
pretty quickly. And so, if you have a 4% money market fund right now, my guess is it's going to come down around a quarter point in the next week or so, after they drop that rate. Um, why is that? Well, because the interest rates are set by the Federal Reserve, and they really impact immediately all the very, very short-term instruments, which are like savings accounts, um, money market instruments. Money market instruments are just really they're bonds or bills that are issued for 270 days or less in maturity. So they mature really quickly. And
Hmm.
so they get replaced very quickly. And so that newer, lower rate goes in almost immediately into the portfolio. And so you'll still have a good rate of return. There's nothing wrong with 3.75% return on your cash. Nothing wrong with that at all. But I'm
Right.
just saying it's probably going down a little bit, particularly if they continue to lower interest rates. Your cash yields or the yields you're earning on your cash, whether it's money market funds, savings accounts, checking accounts, or short-term CDs, are probably coming down a little bit.
Can we talk for a second too in this about the tie to mortgage rates as well? Because that's
Yes.
always a big aspect that one, my clients are looking at, and I know, other people who are listening, like, well, when are mortgage rates going to come down? Um, and they are correlated, right, with what the Fed sets as its interest rate, but it's not the interest rate itself, right? And so to your point, like if they lower a quarter of a percent, that doesn't mean automatically mortgage rates are going to go down a quarter of a percent, right? So
That's correct.
yeah, let's talk about the relationship. So again, you mentioned that when the Fed or the Federal Open Market Committee lowers interest rates or raises them, it affects the 10-year treasury.
Yes. Okay. So as interest rates are changed, again, that's very, very short term, right? That's what the Fed controls. The further away you get in maturity, okay, from that day, 1 day, right? That overnight or that 1 day interest rate, the further you get out in maturity, like 10 years, the less the Fed controls that interest rate. That's called a yield.
Mm,
Okay. And those yields are traded based on different factors. They're traded based on what's the future growth in the economy look like? What's the future of inflation look like? Those are more impactful on the 10 year than they are the 1 day interest rate. So that's why sometimes people are like, well, if it goes down a quarter point in the short term, it should go down a quarter point in the 10-year treasury note. No, it's actually not that way. In fact, historically, it's been about half. So I'm going to make easy math here. So if the Fed lowers interest rates between now and July of next year by 1.5%, okay? That means the 10-year treasury yield is expected to go down by 0.75%, okay? Or 3/4 of a point if we're talking in Wall Street vernacular. So that that half that impact, okay? So now it's lower. What does that do? Well, that impacts mortgage rates. Mortgage rates are based a lot on the 10-year treasury yield. So a lot of times people are like, well, they lowered interest rates, but yet mortgage rates haven't gone down that much. And
mhm,
that's why, because it's based on the 10-year treasury yield, in of which the current interest rate is only one small factor. Um, and so sometimes yields act very differently than changes in interest rates on the short term. Um, so, I mean, if the economy continues to slow, if inflation is still uh, pretty good, relatively behaved, um, then I would expect to see mortgage rates come down quite nicely with these interest rate decreases. But again, it really depends on how investors view the U.S. financial health. Because if one of the risks to my viewpoint there is if investors around the world start to say, hey, they're lowering interest rates, but we think that inflation is going to be higher in the future and real growth is going to be lower. If that occurs, then that yield on the 10-year treasury note may not go down hardly at all because fewer buyers are coming to buy yields to buy those treasury notes at that level.
Interesting. Is that because we've seen this kind of before?
Mhm.
And maybe it was actually when they started cutting rates and they did those first three interest rate cuts. I mean, mortgage rates came down a little bit, but they didn't move very much. Certainly not in, like we were saying, like in tandem with those rate cuts.
Right.
Or to my recollection anyway. I've had clients for the last several years, like kind of like waiting, like when are rates going to come down more? Um, but even to your point, I had kind of forgotten because we talked about it literally more than a year ago, right? When rates were coming down. So yeah, no, that's an interesting correlation there that when the expectation from the consumer is that okay, if my savings rates are lower, if I'm getting less on my high yield savings account, then why is my mortgage rate still, the mortgage rates that
Yeah,
are available still high? And that because that can feel frustrating, especially from like an individual consumer level.
absolutely. Absolutely. It is frustrating for sure because I think people can understand if you're getting paid higher in their cash accounts, they can understand paying a higher mortgage rate. Okay, that makes sense to them. But when you cut interest rates and yields stay the same or go up, that can be very, very frustrating because there's really not an opportunity there to take advantage of those lower interest rates. Um, Again, that's a somewhat of an occurrence, but generally speaking, over a period of time, the yields will kind of follow the interest rate because that's kind of how that's how they set the coupons. So it will come down, but it may take a lot longer than you think. That's not what I'm expecting. I'm expecting U.S. growth to stay pretty mundane, decent, but not phenomenal. As we kind of work through this period of the tariffs really coming through. Tariff price increases haven't really been passed on very much to the end consumer right now. A lot of the companies are eating. A lot of the U.S. companies that are importing goods from overseas are eating that extra cost. Eventually, what they're going to do is slowly bring their prices up over time, which is a good strategy. It's a strategy that helps the U.S. consumer deal with the higher prices over a period of time, and it allows the company to recapture those costs over time. And again, that's where like earlier this year or late last year, I was saying that tariffs can be okay if you do it over a period of time, not all at once. If you do it
Mhm.
all at once, you're going to have a big adjustment in the economy, in the real economy, in household spending. Um, you're going to have a big adjustment. Once that adjustment's over, though, you're done, and you just keep moving on. But right now, it seems like the administration has chosen to kind of bleed these out over a longer period of time, which can be a better way for households to be able to cope with that higher price level.
Well, and then I also saw, I think it was this week, there was a new, I'm not finding it like right off the bat, but there was a new executive order that Trump signed around tariffs, like basically saying like if we can get deals done with different countries, that there will be no floor, no 10% floor tariff, no additional tariffs whatsoever, or truly reciprocal tariffs, because that's not what we've seen so far, right? Like the word reciprocal has kind of been thrown around and not meaning, not in the way that it's actually the,
Defined.
yeah, not the definition of reciprocal.
Yeah.
So with that too, it feels like if that's going to be the case, if all of the tariff, ups and downs that we've experienced so far this year ends up being nothing at all, then that also backs out that, roughly, what was it, 0.9 or about 1% inflation overall that was being forecasted for the entire economy. Um, so yeah, that would also, I mentioned that to say like that might actually be a puzzle piece that is just kind of taken off the table, even though we've seen it here and there somewhere. I've seen kind of anecdotal evidence from different businesses, like especially I'll give the example that I saw of a ceramic studio owner who is not the importer of her products. So someone else imports the clay and the glazes and the products, then she buys them from them, and they have passed on their cost, some of them, right? Like they ate some of them, but they had to pass on some of it because it was too much from wherever they were importing from. So her prices were higher, but she's not like the first line. She's the second consumer of that product. And then her customers are then the third or more consumer of that same product down the line. And her business was like, okay, we'll eat as much as we can, but being that side, when you're the small business owner, there's less margin. There just is. There's less margin to be able to eat that cost. So, I mean, it's my hope
Yeah.
that the tariffs
Yeah,
kind
I
of get
mean, I
worked
think
out.
there's a lot of farmers right now that are really suffering with some of the tariffs and the lack of buying from
Hmm.
overseas because a lot of farmers, we export a lot of farm goods in the United
Right.
States. We export a lot. And unfortunately, because of the tariffs, a lot of countries have decided to go elsewhere for their farm goods. Um,
And that would be what's really interesting because I've followed this somewhat this week too. That's the commodity farmers.
yep.
Right? That's the
Yep.
corn and soybeans that are sold abroad. Especially, there were really big contracts with China for a long time for them to buy a lot of our commercial soybeans and from those big farms. And all of those contracts have gone
They're gone.
elsewhere.
Yeah.
Yeah, like China and Brazil have paired
Yep.
up, in different places. Um,
Brazil is probably the main beneficiary from those. Brazil and China have a pretty tight relationship, or at least it's getting that way. Um, and so they're buying a lot of the excess um, from Brazil, and the U.S. is so I would expect that something is going to have to be done for specific industries. So it'll be interesting to see if President Trump goes down the executive order route or whether he kicks it to Congress to come up with a tariff in those situations, because he's going to have to um, tie it to some kind of support. My guess is in the short term, because the farm economy is suffering a little bit right now. Um, yeah, so that said, I expect bond yields to drop by about 50% of the interest rate decrease. And so as that happens, you'll start to see the ability for certain people to refinance their mortgages. Um, and I mean, Hannah, you're in that spot.
I
You've
am
got
in that
a
spot.
you've got
My
a mortgage that you want to refinance anytime it's financially feasible
right,
and to
yeah,
save some
yeah.
cash or to remodel the kitchen,
Yeah,
supporting that economy. Good. Um,
supporting the small business owners.
that's
Yes,
right.
for sure. And again, like I've clients that have been literally waiting for that relief for the last several years on mortgage rates specifically, because that it's not is interesting. I was talking to a mortgage broker this week. We're going to have her on the show in a couple of weeks. That will be fun to
That'd be great.
talk some mortgage rates. It'll be really good. Um, but she, the talking about that spread between housing prices keep going up in a lot of areas, but interest rates have also stayed high. And so there's that push and pull of, okay, if we've got a 7% interest rate and housing prices are high, that makes it hard for a lot of people to qualify versus if that rate is down at 5% or 4.5%, But then at the same time, if those rates do drop pretty dramatically, people are sort of expecting housing prices to then increase again in some of these kind of tight markets. But I don't know.
Yeah,
We'll
I
see.
don't know. I think it depends on the housing supply in those specific areas. I mean, it's going to be very episodic and very geographically dependent. Overall, I think that housing prices will stay pretty firm. But I think housing builders, home builders, are going to have to start ramping up their their production. I think you're going to see the U.S. government incent more building because what people don't realize is really from 2009 through 2024, uh, the home builders built far less than they usually do. In fact, we went into a housing shortage level in 2021 that was pretty dramatic. And you
Mhm.
can still see that's why the prices went up so much is because people realized one, massive amount of liquidity in the financial system. So mortgages were easy to get and people were trying to buy them. Houses were going up in price because people realized there's more people out there than there are houses. So now what happens? Constrained supply, more demand, prices go up to adjust. And that's effectively what they did. But I think at a point now where that we're kind of at equilibrium until production starts to go up. And that production will go up or it needs to go up. I'm not sure how to incent them to do that anymore. Talking to my sister who is involved in the home building business, said it's really not a national issue. It's an issue with state and local governments and their regulations and all the payments that are required just to get approval for building homes in an area. She says it's a long, long process to get all of that stuff even before you start to break ground or start to sell anything. And she said it's just it's a tough thing to cope with, which is why you see certain cities booming, certain cities don't do any building because just how dramatically different the state and local regulations can be. Um, so
Interesting.
interesting to see, but we should see that perk up over the next couple of years in terms of home building. Um, and I'm guessing the administration is working on something to incent that behavior. I think one of the things that they could fix really quickly is allowing banks to get back involved in financing builders, home builders, and developers. Um, right now, banks just really don't do those loans that much anymore. And um, so they've had to find liquidity or financing in other areas, which that financing is far more expensive than it is on the bank side. So
Mhm.
I think that's an easy way to deregulate a little bit in the financial sector and allow a little more competition in that area. Whereas right now, insurance companies, you have private credit lenders, all of those types of people who require much higher rates of return, those who are financing the home builders. So it's good to know.
Yeah. Well, we will pay attention to that. And like I mentioned, on the 25th, we'll actually have a special guest that day to talk about more interest rates, mortgages, and we'll actually have whatever the result is because next week the Federal Open Market Committee meeting is on the 16th, 17th.
Mhm.
Is that correct? So that will happen next week. So we'll be able to, kind of see how the market digested that. Um, I will be out of town next week. So we're going to have a pause on Investment Friday for next Friday. We won't be here. Um, but the following week we'll be back. So I am looking forward to that. Thank you, Brad, for being on here as usual. If anyone has any questions, any thoughts, any comments, please leave them either in the comments if you see this on YouTube, or send me a DM, send me an email. We would love to hear your questions and support you. Thanks, Brad. See you next
Thank
time.
you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.